Hi everyone, this is Rob Roy and welcome to the Elliott Elite US Market Update. Boy, what a crazy trading day on Friday to close out the week. It was the first trading day of the month. I'll get to why that's significant in the US markets here in a minute, but you can see by the long bar that we had here that the market opened, traded much lower, and then recovered most of that to close down just 5 points on the SPX, the S&P 500 cash index on the day. The Dow had been down nearly 350 points at one time. You can see that we had a breakout here from the little bit of consolidation we had highlighted in the previous week's report about this little triangle that we had here that would likely yield a breakout. And the way these triangles work is you measure the mouth of the triangle. This is one of the Elliott correction patterns that we've been mentioning recently. So you look at the mouth, that's the wide part of the triangle, and the breakout, a very high percentage of the time, for some strange reason, which maybe only really geek mathematicians or Elliott himself would understand, breaks out about the same distance as the width of the mouth. So we had the bottom of the triangle at 2560, the top at 2600, so roughly 40 points. So what that means is you're looking for a 40-point move from the point of the triangle, at least. So call that 2590, so 2630 would have been about where we peaked out, and that would have been on this trading day here, which was the 29th of November. So that all that means, again, nothing's 100%, nothing's guaranteed. You know all the rules in the world of trading. But that would have been the likely move. We actually have a doji on that day, and then we jumped up again. So one could argue that, hey, we were overbought, at least by the rules of corrective patterns within Elliott Wave, and maybe the market was due to pull back a bit. But the main reason that most people cite is there was a report, and I don't even want to give the news organization any credit for this, but a reporter from a news organization came out basically saying that there was proof that the Trump administration had ordered Michael Flynn, that's the big trial that's getting ready to occur here in the U.S., had ordered Michael Flynn to contact Russia. There's all this hoopla that doesn't really matter about whether Flynn contacted Russia, what was said, et cetera, et cetera. And basically, to paraphrase what the reporter said, that there was basically ties that were going to link him to that, and so all of a sudden there was this concern that the Trump administration was going to get hauled into a big legal ordeal and maybe put the administration at risk, and that's what many people cite as the reason the market went down or not. Whether it did or not, I don't know, but later on in the trading day, the news organization brought that reporter back out for a live report who said that, of course, you know, he's trying to CYA a little bit, that some of the aspects of his report were being misunderstood, that there isn't proof of a link, and this occurred before Trump was elected, and basically recanted a bit of the report. And from that point in time, the market did rebound back to the upside. That's another reason why, obviously, a lot of people give credence to that being the cause for the market to come back down. So it's a combination of things. Probably that was an excuse to sell when we were overbought, but we all know we're overbought in general. In fact, over the last couple of reports, we've been highlighting some indicators. Everybody knows the U.S. markets are overbought. We're in one of the longest periods of history without at least a 10% correction. So we're in this record bull run. At some point in time, we're going to correct and have a significant correction. One thing I've been cautioning about is not that we're going to correct tomorrow, but that the longer we go without a correction, at least historically, the more severe the correction is. That's why we want to be careful and be prudent. I don't know when the correction is going to happen any more than anybody else does, but at some point it will occur. And so we've been looking at indicators that may give us some sort of insight of approximately when we can be looking for that to occur. We've talked about volume, and I wanted you to see how much volume there was on Friday's trade, and going up to that on the little breakout that we had on the previous few trading days in the week, we did have an increase in volume. So that's a pretty good indicator that there was some strength in that move. There's never any substitution for price to volume action. And then a lot of volume on Friday as it was heavy selling met with buying. So was the buying due to the fact that we had sold off, and it's viewed, every dip, buy the dip, is viewed as a buying opportunity, or this, I'm sure, played into it. Being the first trading day of the month, as I mentioned earlier, is significant in the U.S. We have lots of retirement vehicles, IRAs, 401ks that use mutual fund type vehicles within them for tax deferred purposes, etc. Purely mutual funds aren't, but there's other vehicles that use mutual funds that are tied in for retirement plans. Anyway, to make a long story short, most of those firms put their money to work, new money that's come in, dollar cost averaging. People are funding their retirement programs every month. Usually the investment company will put the money to work on the first trading day of the month. So quite often you at least open higher on the first trading day of the month rather than necessarily saying it's going to be an up day. Sometimes it drifts off and we finish to the downside, but usually there's a lot of buying earlier in the trading day. Well, with the big sell-off, obviously the buyers are going to step back, and possibly when it got down and then the reporter comes out and kind of adjusts his report, that the mutual fund buying came in, and I just think it was a multitude of factors. But you can't ignore this increased volume that we had on the move to the upside. So everybody is wanting to know, where do we go from here? Well, another indicator that I wanted to bring up is there's a sentiment indicator. We look at the VIX, and so here's a chart of the VIX. So I'll bring this up while I'm mentioning this other sentiment indicator as well. Is called the Bulls to Bears survey. And basically they survey investment advisors in the U.S. as to, are you bullish or bearish? It's pretty simple. A reading of 55% on the bullish side is considered high. So that's not grossly or abnormally high, but it's just high. And from a sentiment indication, remember that it is an opposite indicator. So if everybody is bullish, common sense would make you think, oh, well, the market's going to go up. But it's contrarian. So it usually works in the opposite direction. When everybody's bullish, the markets tend to go down under the theory that, well, if everybody's bullish, as everybody's bought, what's left? Who's left to buy? So if there's no more buyers, where are we going to go? We're going to correct back to the downside. So sentiment indicators, they don't tell you when the market's going to turn. They don't say, hey, it's going to be next week. But it just gives you an idea of where is the general market sentiment. Well, the Bulls to Bears survey ending this week is at 62.3. It reached a high of 64.4 a couple weeks ago. That's way overbought, or grossly in the overbought category, if you will, meaning that it's on the extreme side. The investment advising world is extremely bullish at this point in time. It's another thing to watch when those levels get to the point where at this extreme, typically what will happen is a correction will occur in the not too distant future. Again, it doesn't mean it's going to be next week, but it's just another in the list of signals to keep an eye on that are basically confirming what we already know from common sense, is that the market's overbought. But we're also moving into one of the most seasonally bullish times in the markets, which is the holiday season. Volume dries up, and that phrase that I mentioned to you a couple weeks ago, never short a dull market, comes into play. But the exciting thing for us option traders is the fact that we're seeing some increased volatility finally. We looked at this chart of the VIX last week or two, and you can see that we had very low volatility basically till the end of October, and then we had a little more in November, and then of course Friday was a very volatile day, as you could see from the chart. So volatility is moving back in, but the interesting thing is, look at the base here. We're starting to maybe form a pattern of higher lows, and if we start to get a pretty good solid base of higher lows, maybe that's what the VIX will use as a blast off for volatility. Whether it happens by the end of the year or the beginning of next year, quite often you have sell-offs to start the year when people think that, hey, that's actually a buying time. Remember, we have the whole tax plan thing going on right now, and a lot of people think that any profits are going to be held to next year to take advantage of the new lower taxes. So convoluted mess, just trying to give you more information as to when we might see the long-awaited correction. On the Elliott side, I wanted to show you a chart because this is the small caps, the Russell 2000 and 2000 stocks. There's a lot of smaller companies in here rather than just the 500 and the S&P 500. And we've been talking about another one of the corrective patterns, a zigzag, and this is a great indication of a zigzag. you can clearly see. A lot of people are always like, well, how do you know where to start your measurement? Well, it's an impulse, right? And it's pretty clear. It's pretty easy to see that that was a big impulse move to the upside. So we label that as the A. That was the start of the A wave impulse. And then again, clearly you can see that we had a correction. And the B wave of a zigzag pattern is the corrective mode. It doesn't necessarily have to mean that it's to the downside. I want everybody to remember that in the world of Elliott wave, correction is a move against the previous impulse. So you could have a downtrend with a correction. In that case, the correction would be to the upside. But since the A wave impulse was to the upside, we have a B wave correction. So let's look at our fib levels that play right in here. And when we measure where that impulse started, you can see we had a perfect 38.2% fib retracement. I mean, it touched the fib level. People that don't believe in Fibonacci levels just aren't looking at charts, because how can you ignore that exactly when it touched this 38.2% fib level, it bounced and moved to the upside. Well, there's different combinations of Fibonacci levels in zigzags as far as various lengths of corrections and various then subsequent extensions. So when you have a 38.2% Fibonacci retracement, the expectation then is for a 61.8% fib extension. So if we take a look at the fib extension tool and we measure this move, you can clearly see that we tapped the 61.8% fib extension on Thursday. So we reached the end of the zigzag. Now, does that mean that the entire pattern is over? No, it means it has satisfied the rules, and now we have a complete qualified zigzag pattern. However, if you're familiar with Elliott wave at all, you know that patterns can become extended. And for a pattern to become extended once you've reached the target, which again that did, it's about as perfect of a zigzag as you could expect to see. If you're going to go to the next level, if you're going to be in a corrective pattern, which 100% up there, as you can see, would be the next targeted level, the rules state that you test the previous level first. So not only did we come back down to the 50% level, we came all the way back down to the 38.2% level on Friday with the crazy volatility, which means we've satisfied that rule. So does that guarantee that we're going to see an upward move to the next fib level? No, but it means we've satisfied the rules that would allow that according to Elliott wave corrective patterns, and specifically the zigzag pattern. Now it could be the very end of it, and maybe we go sideways for a bit and head back down. Obviously next week will tell us a lot, but as far as the rules state, with the small caps, which a lot of people look at as market leaders, we have satisfied the rules that would allow us to go even higher. Possibly that melds in well with the fact that we're in the most bullish seasonal period of the entire year. So possibly we go up, then we hit the 100% level, then we're very extended on basically any indicator you could possibly look at, which just might set us up for some sort of a correction in January. But we'll certainly keep you posted. Thanks for your attention. Hope everybody had a wonderful week, and we'll be back to talk to you again next week. Take care, everybody.